Thank you very much to PEO for having us today. It's a real honor to be speaking at the 10th annual conference, as I learned this morning during Leon's presentation. I'm James Stellick with Focus Asset Management, and we are proud to be an educational partner of PEO. And we're proud and we're humbled that PEO members and their families choose us to help protect and grow their wealth and navigate this very uncertain environment that we're in. And what an uncertain environment we are in, as we'll hear a little bit later. But I think we can all kind of feel it intrinsically that 2022 has presented a level of uncertainty and a series of challenges probably that we haven't seen in decades. So why don't we start out maybe with a little bit of a straw poll or some high-frequency data, as David would call it. By a show of hands, so we know that inflation's at or near 40-year highs. By a show of hands, who in the room is feeling the impacts of inflation on their business? I heard some chuckles. I see a lot of hands, and the lights are bright, but what do we call that, 80% maybe?
It's I'd say more like 79.9246. But if you want to round up, that's your business.
With a 2% margin of error.
There you go.
So we'll continue our straw poll here. We know that interest rates have gone up rapidly in an effort to quell that inflation. We know there's a lot of debt in the economy and in the system, as we'll no doubt hear more about later. Who here is concerned somewhat or very concerned that rising interest rates might pose a challenge to the economy? David, we got your hand there. Probably another 80% plus or minus.
Go figure, inflation and interest rates. Interesting.
There you go. And finally, why don't we ask, playing armchair economist, as Leon admitted to doing a little bit earlier on, who here thinks it's likely or very likely that we might see a recession in the next 12 months before our next PEO conference? What's that? A little, maybe 70 to 75%.
Fair enough.
So I'm not delusional. I'm not the only one who's feeling uncertain, and that gives me some comfort.
If that makes you feel better, go for it.
I'll take it.
Misery loves company.
So our view at Focus is that when you're faced with an environment of uncertainty, as we are now, and as some of us will be at the late night casino a little bit later on, that sounds like fun. I'll have to make an ATM stop before Professor Stein, Leon. I'll remind myself to do that. But in an environment of uncertainty, we think it's important to take a probabilistic view and to understand and prepare for the range of outcomes that might come to pass. And to do that, you really need to incorporate a diversity of opinions, and you need to listen to forecasters that maybe aren't afraid to diverge from the herd and offer out an opinion that doesn't jive with kind of what the mainstream consensus is, which is a long-winded way of bringing us to why we're so excited to have the man here seated to my right. He's had a long and illustrious career, as we heard, on Wall Street and Bay Street as an economist and strategist. At Focus, we are research clients of his firm, Rosenberg Research, and we enjoy and hold his views in very high regard. And he is not one who is afraid to pull punches or go against the grain, and we know he's going to call them like he sees them and speak his mind today. David Rosenberg, great to have you here.
Well, it's great to reconnect this way, just like the old days of Gluskin. So I'm excited.
The shared alma mater. Why don't we just start by mentioning, we've styled this fireside chat as interest rates, inflation, and investing, which is good because it seems to be on a lot of people's minds in the room. But we want to tailor the conversation to the questions that you have or maybe the challenges that you're facing in your business. So after an opening salvo or two for Mr. Rosenberg, we'll have the dynamic team circulating the audience with microphones. So please raise your hand and ask a question of Dave that might be on your mind, and we'll look forward to having a great free-flowing Q&A session as well. So Dave, you began your career on a Monday in October of 1987 on Bay Street.
October 19th, 87.
That day would go on to be known as Black Monday, through no fault of yours.
Some people blame me.
So that's known as Black Monday because it marked the largest one-day decline in the stock market in history.
Down 23%.
You still remember it well.
To the decimal place. Since I bought Bank of Nova Scotia stock the Friday before.
You bought the dip.
That was my first day on Bay Street. I got hired as the financial economist in the economics department of the Bank of Nova Scotia. I was working 3 years prior, right out of school at Canada Mortgage and Housing. So I was a housing economist and a civil servant, but I just had this, I don't know what it was. I wanted to come back to Toronto. I don't know what it was about Bay Street that attracted me, but they gave me a shot. And my first day on the job, my first day on a trading floor was that day. It was pandemonium. And I'll just tell you that, it stays with me today that, if somebody had offered me around 8:30 in the morning as I'm walking on the Bank of Nova Scotia trading floor over at Bay and King, offered me the Voyager Colonial ticket back to my cushy job in Ottawa, I would have taken it. People were like, it was pandemonium. It was crazy. But we haven't seen a 23% decline in one day. But my whole career as a street economist was really built into massive turbulence. But that explains, you see, why I walk around with this dark cloud wherever I go. There's the perma bear. There's the perma bear. I say, well, you start your career October 19th, 87, and you'll see how it feels. Okay, so.
This is great. We're facilitating dialogue, and we're creating understanding, which is fantastic.
I'm just reading the teleprompter.
Okay. There we go. On the subject of maybe being a perma bear, you gave me that intro there. But we're subscribers to Rosenberg Research, and I start my morning with a coffee and breakfast with Dave, which is your daily missive every morning. And I have to say, I take my coffee black. Lately, I'm tempted to include a side of Bailey's, Dave. You've been unequivocal and vocal in your view that a recession is coming. Tell us what you see in the economic landscape and what causes you to arrive at that view.
Well, look, I deal in, and I think we all should, and what I really like is I can speak to all the people in the room as also as a business owner, and not just economist in ivory tower. And we're always playing, I think whether it's in your professional life or your personal life, we're always thinking about probabilities of events and outcomes. So, when the Fed and the Bank of Canada started raising rates earlier this year, I was saying, okay, we are in a new, without trying to time it, we're in something new. We are in central bank tightening mode. And by the way, since I started in the business in 1987, I've got a lot of these cycles, under my belt. And I said, when we start going through these periods where the central banks start to raise interest rates, historically, 80% of the time, we go into a recession. Now, could it be a year later, 2 years later? I just had to tell my clients, just know that it's out there, but we also have to assess how far they're going to go. So I'm just saying that there is a 20% chance that we get by with what's called a soft landing, which is the economy slows but doesn't contract. Economic contraction is like a national pay cut. That is different. The economy going into reverse is different than a slowdown. 20% of the time in the past, the economy actually did manage a soft landing, in quotes. And so I kept an open mind that there's a 20% chance, but the base case scenario was that we're going to have a recession in the next couple of years. And then I have to pay attention to what the markets are telling me, right? And so I'm a strategist, I'm an economist, which means that there is, as always, this symbiotic relationship between the markets and the macroeconomy, and the macroeconomy and the markets, and they feed off each other, and they lead each other. So when I started to see not just the stock market go down, and not so much in Canada, because energy didn't go down that much for reasons that we know, but I started noticing globally, and especially in the United States, that when the deepest cyclical stocks, the capital spending stocks, the financials, the consumer cyclicals were going into a bear market, I started saying, well, the stock market's giving me a message here. And alongside that, the central banks, it comes down to your other question, of course it's been overkill. Of course it's been overkill. The central banks, especially Tiff Macklem and Jay Powell, I'm not being critical. I'm just saying this is what it is. They have continued to raise interest rates, let alone shrink their balance sheets, but they've raised interest rates into an inverted yield curve. Now I want to see a show of hands. Who knows what I'm talking about when I say an inverted yield curve? Nobody knows? Okay, in a normal situation, in a steady state normal situation, in the middle part of a business cycle, say, what's normal is that long-term interest rates, long-term bond yields, say 30-year Government of Canada bond yields or Treasury yields, historically are above where short-term interest rates are. Short-term interest rates might be 2%, long-term interest rates might be 4%. That's normal. That's the time value of money. And while you want to take a look at this relationship between short-term interest rates and long-term interest rates in the money market and the bond market, is because as business owners, now I've got the luxury of being an economist on Bay Street and Wall Street, so I've watched this stuff, but it's a great leading indicator for the economy. So when we go to a situation where short-term interest rates go above the level of long-term interest rates, which is what we have in our hands right now, that's a very unusual situation. And it's the bond market's way of saying uncle to the central banks. When short-term interest rates go above long-term interest rates, which happens in aggressive monetary tightening cycles, which we are surely in this year, you have a 90% chance of recession. So you go from 80 to 90. So it's not just are these central banks tightening liquidity, raising interest rates, and we usually, often quite inadvertently, a lot of the time the central banks don't intend to cause a recession, but we fall into one. Sometimes, like under Paul Volcker, he deliberately tried to create a recession, and he did. Quite often, it's just the nature of the beast. It's like basically this, to everybody in the room, the best economist of all time. When I said who are the other two, the best economist of all time was a physicist, youngest Nobel laureate in science and history was Albert Einstein, who famously said that the power of interest rates is the eighth wonder of the world. And it's really all about interest rates. And interest rates is what determines how you discount future cash flows, which is, as business owners, what we should be thinking about. And so what's happened is that they inverted the yield curve. They raised short-term rates above long-term rates. Therefore, all of a sudden, the odds go from 80 to 90%. And then there's one particular metric that I look at, and often I say to people, honestly, just put me out of business. The conference board puts out a leading economic indicator. It's a hodgepodge of 10 different things: capital goods orders, building permits. It's got some financial indicators in there. And it goes back to like 1958. And when it goes down 7 months in a row, which it has, and it's down at over a 5% annual rate, what I'll tell you is that a recession follows within the next quarter or two 100% of the time. So my evolution has been looking at whatever crystal ball I look at. Central banks start to raise rates. Okay, we got to be on watch because they usually slip up. Or maybe these central banks want to create a recession. They're so freaked out over inflation, they want to kill demand. Okay, you got Jay Powell. Jay Powell thinks he's the modern day Paul Volcker. Well, Paul Volcker killed inflation, all right, by killing the economy from 1980 to 1982. It was 3 years of hell. It can't be done. So we have a new dynamic, which is central bank tightening. The next dynamic, yield curve inversion. And then the next thing I'm noticing is that the official leading economic indicator is actually provided a 100%. So if we don't go into recession, it'll be the first time that's happened based on the pattern of the leading indicator that's been around for the past 7 decades. So I think a recession staring us in the face. A message for the 25% people that didn't put up their hands. I think that it's just part of the business cycle. I'm trying to actually take away that dark cloud from October 19th, 87. You see, October 19th, 87, we had a stock market collapse. Everybody thought there was going to be a recession. And the Bank of Nova Scotia actually cut half the research budget. You know, I just started. I just left Ottawa, you know, to go to this insanity called Bay Street, and they thought there was going to be a depression. Was anybody there at that point? They thought there was going to be a depression because of the collapse in the stock market, which was a liquidity event. It wasn't an economic event. And the central banks had been raising rates, but they didn't invert the yield curve. There was no recession. The recession came about 3 years later. Thank you to John Crow. But the recession came roughly 3 years later. I was told, so they had to cut half the economics department. I just started there. You know, I mean, I was bringing underwear to work, like new pairs, just to get changed every. It was really frightening. My boss said to me, when they let go half the department, he said, "Hide under your desk." But nobody ever came to get me. I was there for 3 days, but I managed to. I managed to survive. But you see, that was a liquidity event, okay? And what did the central banks do right away? Was they flooded the system with liquidity and they cut interest rates. And in fact, they re-steepened the yield curve. Then, by the way, by 1989, they inverted the yield curve. And then we had the recession in 1990. That's why anybody who's shaking their heads, what's he talking about the yield curve? And I promised I wasn't going to go overly technical. Everybody talks about the stock market being a great leading indicator, and it really is. But the bond market is also a very good leading indicator. You have to take a very athletic approach and watch everything. Watching the macro variables, the leading indicators, not the coincident indicators, but the leading indicators are all flashing 2023 recession. And that's exactly what the markets have been telling you what to expect. We can talk about, has the stock market bottomed? Has the stock market not bottomed? We can talk about the markets, and I'm sure we will. But remember, the markets provide price signals on the economy. And if we're running our businesses, we have to really respect what the financial markets are telling us, including, by the way, the commodity markets. But they're not quite as leading as the stock market and the bond market is. They're telling us we have a recession next year, which means we have to really, all of us, run our businesses much more cautiously in terms of how we manage our costs, manage our inventories, manage our staffing. Next year is going to be, if you think that this past year was a roller coaster ride, you talked about uncertainty, it wasn't so much uncertainty for the economy. All the coincident economic indicators are doing just fine. But I don't live that way. I try to drive looking through the front window. And so the front window is different than what's happening right now. Right now, the coincident indicators are fine. Frankly, I don't really care. I care more, what will these coincident indicators be doing 6, 12 months from now? So if you think that we had a wild roller coaster ride in the financial markets this year, they're telling you we're going to have a hell of a ride for the economy next year. So even as things bottom out next year in the financial markets, and my clients will be buying stocks because they've cheapened up a lot, and they'll be pricing in a better 2024. As far as 2023 is concerned, it's going to be a recession, and what we really don't know is how deep it's going to be and what's going to get us out of it. What has to get us out of it ultimately is going back to a declining interest rate cycle. These central banks have to be convinced that inflation is going down, but they're so wound up about being wrong on inflation, which, by the way, I don't think they were wrong on inflation, and we could talk about that. But they feel Powell, Tiff Macklem, Christine Lagarde, they all feel that somehow their credibility was attacked these past 18 months. So I think the big risk is that when it comes time finally to take the foot off the brakes, they're going to be really way too slow. So it might well be a deeper recession than people think.
So why don't we come back to that topic of inflation? Because I noticed you didn't have your hand up when 80% of the room did indicate that they were concerned about inflation. Oh. Is the inflation dragon all that it's cracked up to be at the moment, or is this, as you say, overkill by central bankers? And what would be, we came from an environment of disinflation where there was lament years ago that inflation was not high enough and was below the Fed's 2% target. Where do you think the long-term level of interest rates settles to after all this?
What was your first question? So look, the question that you asked the group was, is inflation having an impact? And of course, inflation is having an impact. Inflation is really a coincidental-like indicator. The question is going to be more appropriately, like when I talk to people that are in the financial markets, the important question is, where's inflation going to be 12 months from now, not where it is today. So, let's look at this situation. Of course, we had very significant inflation over an 18-month period. We had a series of shocks, a series of inflationary shocks, one after another. We had the pandemic. We had the COVID. I started my business 2 months prior, and everybody thought, like, we didn't know. Who knew? Who knew? We thought it might be the Black Plague. Like, who knew? Do you not remember? I mean, I remember walking in the streets in my neighborhood, and there'd be a mother with a little girl, and they'd cross the street because I was some alien from outer space. I mean, we got to stay away from that man. It was. You remember that? I mean,
Are they subscribers?
Look what happened. Farmers were culling their herds. Nobody ever thought we'd go to a restaurant again. We had massive food inflation, like right away. And all of a sudden, who was going to live in a high-rise again? Who will ever want to do that? So all of a sudden, there's an abrupt halt to multifamily construction. We had all these series of shocks. You see, the thing is that you would think that, well, because on the demand side, this is actually deflationary. And for a period it was. Remember, there's a period, by the way, in April of 2020 when oil prices technically went below zero, if you can believe that. The futures went below zero. But what happened was that it was a huge constriction on the supply of everything. And if you're going to forecast inflation, you need demand and you need supply. And what happened with COVID was the impact on supply overwhelmed the negative impact on demand. Then we have the lockdowns, which was an added constriction on supply while we're paying people not to work. So the government didn't want to see demand go down, we'll pay these people not to work, but the economy is shut down, and that has a huge impact on supply. Well, any basic economics 101 course will tell you, looking at the supply-demand curves, we're going to get some inflation, which we did. But then they overdid it on the fiscal stimulus, big time. And of course, because we had the variants, we had Delta, then we had Omicron, and then we had the first shooting war in Europe in 80 years. And wars are inflationary. And then all of a sudden you have an extra impetus into food inflation, wheat, and the grains, and oil, and of course the energy crisis that we have in Europe that comes out of this. So we've just been hit in a short period of time. In the overall annals of economic history, this is a short period of time, multiple inflationary shocks. And so the central banks who are telling everybody transitory, their problem was they never defined transitory. Transitory is really meaningless. They just should have said, this is actually how we define transitory. 18 months is transitory. To me, I'm an economic historian, 18 months is transitory. But you see, when you start being told by the all the people on TV and in the media that you've blown it on inflation, these central bankers started feeling that they're losing their credibility. I never felt the markets never said they lost their credibility, but what I'm saying is that we did have the inflation. A lot of the inflation was on the cost side, so of course everybody's going to feel it, because unless you can raise your prices faster than your costs have gone up, your margins are going to get squeezed. Now people talk about the labor market, well, that's something else that happened with COVID and long COVID and the inability for some industries to find workers. That's a big problem. You could say that on the labor market side, that's some cost push inflation. That's really mostly in low-skilled, low-value-add restaurants, movie theaters, theme parks, in terms of the unskilled. And those people actually coming out of COVID actually have seen the biggest wage increases. And maybe from a society standpoint, that's not the worst thing in the world. But you see, we had a health crisis that was global, and we had a war. And the last time we had something like this, sample size of one, but only one that we really have data on, was what happened exactly a century ago. We had World War I followed by the Spanish flu. And when people talk about, oh, inflation 7%, 8%, look at this. I got news for you. In that period, say from 1960 to 1920, inflation was 15% per year. It wasn't 18 months. It was double what it was. And guess what? Guess what happened? Once these supply side pressures subsided, which they naturally will, we reverted to the mean. And we went 10 years from 1920 to 1929. And of course, 1929, we had a huge deflationary event, October 29th of 1929. Now, I wasn't there for that one. That was a bigger decline. But we had 10 years of disinflation or deflation. You know, F. Scott Fitzgerald writes The Great Gatsby in 1926. You look at that, there's no mention of the Great Inflation. There's no mention of the Great Inflation. No mention of the Great Inflation from World War I. You know, so I'm going to say that in 4 years, we will not be talking about inflation anymore. And it all comes down to how you want to find transitory. Of course, these central banks are overdoing it. I think this time next year we'll be in a deflation. I think we're already seeing it in assets. We're seeing it at home prices and equities. And you're starting to see, I mean, every single measure, every measure of freight rates. I'm looking at commodities. Now, commodities aren't plunging, and there's reasons actually to be very long-term bullish on the commodity sector. Looking at the greening of the world and the fact there's been no capital investment in the basic material industry, maybe that's very good news for Canada. But the point is that commodities are off their peaks. Oil is not $125 anymore. You know, copper's down like 30%. Wheat, corn, soybeans, all the stuff that was raging just 6 to 9 months ago have all come down. They're elevated, but, you know, prices stayed elevated all the time Paul Volcker was in office from 1979 to 1987. Prices stayed elevated, but inflation is not about the price level, it's about the rate of change. So I think that the central banks are determined to kill inflation. That is really, in some sense, was always beyond their control. The fiscal stimulus is in the rearview mirror. I'm looking at all these different freight rate measures, as I said before, commodity prices. I'm looking at different measures that assess global supply chain problems. Who hasn't been affected by that? I mean, Canada is a small open economy. We're very highly dependent on global supply chains, but you see, they are coming back. Of course, the one thing I didn't mention that was super inflationary was what? I should have mentioned this, was, I mean, God forbid, China gets 5 COVID cases, and then Beijing shuts down port cities of 20 million people. But you see, they're now starting to ease up. And one of the reasons why the Chinese stock market, if you're watching these things like I do every day, their market's starting to come back from a very low level, because there's this anticipation that Beijing is going to start to relax their COVID rules as early as next year's second quarter. Well, I'm saying that would be a very good thing to help bring global inflation down. So these global cost pressures that have come from the war, that have come from COVID and all the direct, indirect consequences of COVID, they're increasingly in the rearview mirror, okay? What is ahead of us is what these central banks have done to the demand side. Like I said before, you can't forecast inflation with one curve, you need both. They've overkilled. We're going to see here next year, and we're going to go, wow, did those guys ever, just as the same people were saying, oh, what a bunch of idiots, they blew transitory, will be the same people saying this time next year they overkilled. And I think they'll be cutting rates again under totally different circumstances than we have today. Totally different stock market, totally different economy, totally different inflation. So I would say that for the people that are concerned about inflation right now, our concerns are going to shift from inflation to the economy within the next 12 months. The concern will not be, is inflation your top concern? It'll be, what is your order books looking like? Because remember that these central banks, interest rates are interesting. They operate with a lag because people respond with a lag. People don't respond. You know, the central bank doesn't raise rates on Friday. We all respond on Saturday. And interest rates, whether in the mortgage market or your credit cards or your auto loans or your furniture loans, they reset over time. And then people start to see the effects of these rising interest rates. They adjust their spending patterns, and there's all these multiplier impacts on the economy. That is what is staring us in the face for next year. or the lags from all what they've done. Okay? And then they'll adjust rates. Interest rates are cyclical. Our businesses are cyclical. Even the businesses that are the most non-cyclical, even Walmart, which came out with great earnings. Everything is cyclical. Everything to varying degrees will move, ebb and flow with the cycle, including interest rates. And I say to people, by the way, yeah, the bank's going to raise rates again. The Fed, they're barking and barking and barking and biting, yes, for the next 2 or 3 months. But I'm saying, for those of you with a 12-month view, rates are going to come down next year and come down hard. People say, what about the inflation? They can't do that because of the inflation. Yeah. Do you think inflation is going to stay static? What in life stays static? Do you think inflation is going to stay where it is today? And when I'm tracing through everything that's happening, all the pressures on inflation, supply and demand, I think the big surprise next year, you see, because the consensus is that inflation is going to be sticky. It's not going to come down that much. I'm taking the other side of that bet. I think inflation is going to come down very significantly next year. Worst thing anybody can do, and I find this is always a trap, is extrapolating your most recent experience into the future. When it comes to inflation, I'm just focusing on what I've always focused on. I'm taking my tools as an economic seer, and I'm trying to see where are the pressures going. Where are the pressures going? And although inflation is elevated, and we got the numbers today for Canada, although if you strip out food and energy, you strip out food, people love that about economists. Rosenberg, they say, if you stripped out everything, the CPI would be 0. Yeah, I know that. But the underlying pressures on inflation, even in Canada, are starting to fade, and I think that'll be a very big story next year too.
Interesting. Well, I promised that you weren't afraid to go against the grain, and you're proving me right. So that was one good forecast so far today. I just say we're open for questions and answers. So if you have a question for Dave, we'll do our best to see you through the lights. But please raise your hand, and a member of the team will be by with a microphone. Dave, you've unpacked a lot of interesting topics today about the economy and interest rates and inflation. When you put it all in a blender and you think about what the implications might be for capital markets, public stocks, public bonds,
Yep.
What's your outlook like for those asset classes?
Well, I'd say that, and it's a big debate right now. Everybody's asking me, has the stock market bottomed? Has the stock market bottomed? Has the stock market bottomed? And my answer doesn't change. I say leave the bottom picking to the proctologists. Okay, they do it a lot better than the rest of us.
This is a family show, Dave.
And hope I didn't give anybody a bad case of indigestion with that one. But here's what I'll say is that this year for the stock market, okay, was about the price earnings multiple compressing from very high levels to really levels that I wouldn't even see they're cheap. They're basically roughly in line with their historical norm. And that's because interest rates have gone up. And so the central banks have raised interest rates, and there's a time-worn relationship between interest rates and what investors are willing to pay for their equities, in which, other words, is the price earnings multiple. Earnings haven't come down yet, right? Earnings haven't come down yet. We have not seen the recession yet. We have not seen the real recession yet. I know people say, well, but we had back-to-back quarters of negative real GDP in the United States in the first half of the year. That was really food and fuel. That was the squeeze. That was the inflation squeeze on the economy, the impact it had on real incomes, real spending. But you see, employment didn't go down. Well, come on. How are you going to have a recession and no employment loss? That's going to be next year's story. So the real recession, the real monetary policy-led recession is coming next year. So what am I left with? Again, I go back to the history books. And I don't believe that, it's different this time. We haven't seen the earnings recession yet because we haven't really seen the economic recession yet. And in recessions, with a very tight standard deviation, corporate earnings go down 20 to 25%. So you see, leg one to the bear market was the PE multiple and the impact that that had from higher interest rates. Next year will be the recession's impact on corporate earnings. So I actually think there's another 20 to 25% decline next year in the stock market. And it's not about interest rates going up anymore. It's about the lagged impact of the rate hikes this year into the economy next year. And so what's very interesting is that people say to me, this is the most well-advertised recession of all time. And I'm saying, well, that's very interesting, because if you go to the consensus earnings estimates from the analysts, they think earnings are going up next year. Well, I got news for you. There's never been a recession where earnings went up. So it's actually not baked into the stock market. I'm very bullish on bonds. I'm very bullish on bonds, the most detested asset class. But I think that we're going to have a recession, okay? Bonds do well in recession because of their more safety characteristics. The one thing that makes a bond different than a stock, and maybe what makes a bond trader different than a stock trader, is that bonds mature. Okay, so basically, well, that's a Bay Street joke. Nobody really got it. I get it. So
Our friends at Richard Pillisoff like that one.
So the thing is that I like, and actually, speaking of Richie's shop, there's parts, I like corporate bonds. I like corporate bonds. Corporate bonds actually have a lot, so you actually will pick up some spread. I know people will say in a recession, why would you own corporate bonds? Well, just buy ones that are in stable industries with reasonable cash flows, have visibility. Corporate bonds actually are attractively priced. I'd buy corporate bonds now as an asset class over stocks. I also like government bonds because I think that yields are going to come down. Yields are going to come down, and you're going to get a nice capital gain out of the bond market. I think that if I'm right on where inflation goes, the economy goes, I think that long government bonds will generate a return of between 20 and 30% next year. Now, of course, I got to sit down with people and show them how that math works, how the convexity math works in the bond market. I don't think the stock market's going to do that for you next year. So I like bonds, and maybe this time next year I won't like them as much, because if my forecast is right, they'll be expensive. Stock market will be cheap. But I also, again, I just know my history. Like, I know my history. Who's an accountant in the room? Any accountants? There's a handful, because they economists are accountants with personality. Sorry about that. So it's just basically, it's accounting 101. It's FIFO, first in, first out. It's like that with the markets. And you're going to notice this historically. And I followed this, like, I can't tell you, almost for centuries. To show you what I do for fun, I open up my Homer and Scylla book called The History of Interest Rates. His interest rates back to the Phoenician period. And I could either do that or take 5 milligrams of melatonin, but sometimes I'll just do that. But you'll notice that that the first asset class that goes into the bear market is the first asset class to exit the bear market. Okay. So the first asset class, because of course we're so equity-centric, what did Dow do? What did the S&P do? What did TSX do? The bond market was the first asset class to go into the bear market back in the summer of 2020. And the stock market went into its bear market starting basically, call it December 2021. And then the commodity market went into its bear market in June of this year. So the bond market will come out of this first. And actually, bond yields have started to come down. The bond market's starting to finally sniff out the not-so-rosy scenario, and they are starting to rally. And you could say, well, the stock market's come off the lows too, but I think that that's a head fake. And the one thing I'll just say this is that when you're looking historically, very interesting, is that when you get to the bottom in the stock market, and the stock market will bottom, I'm not going to say there's no bottom to the stock market. I can't wait for the stock market to bottom so I can turn bullish, and they will say, did you hear Rosie turn into a perma bull? I'm looking forward to that day. But you see, bond yields are going to have to come down first. Bond yields will have to come down first to give the stock market the relative value support it's going to need to go into the next bull market in equities. And so for anybody that, rolling their eyes or shaking their heads, what's he talking about? It's called the equity risk premium. It's at what point will the bond yields come down enough? Because right now, the reason I said bonds right now are more attractively priced than stocks. When that relationship ends, bond yields would have to be a lot lower. So you see what I'm trying to say here very simply is that there is no bottom, if we're picking a bottom, in the stock market in advance of a decline in bond yields. And the decline in bond yields, if I'm right on this forecast, because that will give you a capital gain. I'm not saying necessarily you have to hang on to these bonds to perpetuity, but it's going to give you a very nice capital gain. I think that'll be the place to be for next year, will be the government bond market, Canada's and Treasuries.
You made an interesting point there, David, which is to say that not only are equity markets in a bear market, but bonds are actually in a bear market as well and have performed worse than stocks in some cases.
We're in a bear market.
As of a few weeks ago.
Well, you know, the long bond in the United States, the long bond, what we call the bond, the 30-year has gone from 4.5 to 3.9. 60 basis point decline is not chump change. So I think something is happening. The bond market's giving us a certain message here about the economy. It's actually telling you to also be very, very careful about how to treat these bear market rallies in the stock market. But the bond market is actually performing, well, actually how I thought it was going to perform a little while ago. But that's performing very well right now, but it's giving us a message again on the economy.
So from a portfolio construction standpoint, most high net worth investors in Canada, their portfolios look like some combination of stocks, which are in a bear market, and bonds, which are in a bear market. And they've been able to count on a nice kind of inverse correlation between those two asset classes, which hasn't been extant this year and has caused some pain. I was reading research that for a stock and bond investor, it's actually been worse than '08. And you have to go back to the 1920s by some measures to see this much pain.
Well, I get that. 1937. So the comment is about the 60-40 asset mix, the classic asset mix that every broker comes to and say you got to have 60% in stocks, 40% in bonds. And it's you know, I don't know if the word unfair is right, but maybe it is, because what was the starting point? Because we thought it was the Black Plague, because like these central banks went crazy. Well, we all went crazy. Like, who knew? At that point in time, in 2020, the spring, long-term interest rates were like 0.5%. So, you know, we start this bear market in bonds with what's called you had no coupon protection. You had no yield. And when you're talking about convexity in the bond market, what it meant was that you did not need to have much of a rise in yields to generate a negative total return in the bond market. I know you're not supposed to lose money in the bond market, and there's a lot of people that were very upset about losing money in the bond market. But I said before, you never lose money in the bond market if you don't sell, okay? Because the bonds will mature at par. The thing about the bond market that is unlike the commodity market or the stock market is the bond market. I'm talking about the government bond market because there's no callable risk. Is the only asset class. What makes government bonds special is it's the only asset class where you know in 5, 10 years what you're going to get paid. And that's why there should be special in everybody's portfolio, is that guarantee, that safety. But you see, what people talk about is when they get their statements, oh my God, I'm down 15% on my bond portfolio. Yes and no. If you had to market your portfolio right then and there, yes, it's negative. And that's because bond yields went up. Bond yields went up. It wasn't the Black Plague. We had the reopening, we had the vaccines, then the central banks start raising rates, and the whole bond yields go up, and you're stuck with a negative return, ... for now. And then in the stock market, let's face it, we went into this year with multiples in the stock market, second highest of all time. Second highest peak of all time, only surpassed by the dot-com boom back in 1999. So your starting point on valuations left the stock market very vulnerable to negative returns. The starting point on yields left the bond market very vulnerable to negative returns. And so then you read all these headlines, horror headlines about 60-40 doesn't work anymore, and look at these negative returns across these asset classes. I said before, the most dangerous thing to do in this business is to extrapolate your most recent experience into the future, okay? So because 60-40 didn't work this past year, and it didn't for the reasons I cited, mostly because the starting point in both stocks and bonds was so egregiously expensive. but bonds have repriced. I would tell you right now, again, I play the probabilities. What if I told you that when your starting point is 4% on the bond yield, in the next year, you stand a 92% chance of making money? You'll at least pick up your coupon. Oh, I sort of like those odds. Now, I'm waiting for the price earnings multiple in the stock market to get down to those levels so I could say, aha, eureka, I'm going to pick the bottom. And there's going to be a 92% chance that you make money in the stock market. I want to get there. I will get there, but it's probably not going to be till this time next year. Hopefully you'll invite me back. I'll be a permanent bull at that point.
David, we're running out of time, and we do have David over here that's chomping at the bit with a question. Can we take a couple questions before we finish up? Is that okay?
You're chomping at the bit. I thought that was your difficulty with that last piece of chicken.
There's a little bit of sensationalization going on there. But, so this maybe is a little bit of a different topic, but related. For my sort of adult career, the Canadian dollar has been, I think anyway, pretty highly correlated to the price of oil. And it seems that maybe that's changing, and I wonder if you had any comments about that.
Well, it is a high correlation, but it's not a perfect correlation. And where it can break down is when you start getting house prices coming down like they are in Canada. And when that starts to feed into expectations as to what the Bank of Canada is going to do. Let me just say that the more powerful relationship, not that oil's not important, and so is, by the way, so is natural gas. So are commodities in general. It is still a petrol currency, but if you're running a model in the Canadian dollar, the most important correlation is what's the Bank of Canada doing relative to the Fed. And I think you're starting to see some nuances where the Bank of Canada is probably a lot closer to ending their tightening cycle than the Fed is. And that's going to cause U.S. interest rates to become more attractive than Canadian interest rates. And that's a much more important relationship for the currency than oil is. That's why it may appear that oil's not as important. It's not that oil's not important, it's that something else is more important. And it's Canadian-U.S. interest rate differentials.
You're the expert, I'm not. I think that works for minor changes and over short periods of time, but like a few years ago when we went to parity, that seemed like it was much more tied to what was happening in commodity prices and oil and those kind of things. I don't understand how the Bank of Canada's action would get us back to parity, for example. For my business anyway, this has been the biggest variable.
The Canadian, I don't know about if we're going to go to parity, and parity is just a number. Okay, it can go to 80 cents and go to 90 cents. Parity is just like, it's a nice round number. Okay. I think that the long-term view on the Canadian dollar has to be positive because we have the things that the world needs. And we're going to find this out more and more. We haven't seen, what does the world look like? What does the world look like without Russia as part of the world order in the future? This war just started, like 8 months ago. And what is it going to mean for global supply chains as we go to nearshoring, onshoring? We have the resources. We just wrote a whole report, by the way, on Saskatchewan. And it was called Saskatchewan Has What the World Needs Now, ... in the future. All the stuff that's needed for greening the world, we have. And energy, fossil fuels, we have. Wheat, and LNG potential. So I'm not bullish on the Canadian dollar on the near term because I think that I think we're going to go through the ringer on this house price situation. And our debt, our house price and debt ratios are worse here than they were in the U.S. back in the mid-2000s. And we haven't seen the full impact hit home from what the Bank of Canada has already done. So I'm not bullish on the Canadian dollar for the next year, but you're going to say to me, do I like the Canadian dollar on a 3, 5, 10-year basis? Yes, very much.